Well, in Friday's trading session, the U.S. markets, they ended in the red. All the three frontliners, they ended in the red. There were fears that resurfaced whether or not the United States and China, they'll come to a deal or not in terms of the trade war tensions. So on the back of that, we did see some profit booking. The Nasdaq was a relative underperformer. That was down close to around 1% approximately. But a whole host of cues did come out of there. We had Larry Kudlow, the economic advisor of the Trump administration, who said that there was no real progress in terms of a deal. And in fact, nothing really had moved out there. So that was some commentary that spooked the markets. In addition to that, we had the Nasdaq that underperformed. Why? Because Apple did see selling pressure. But the economic data looked very, very good. The number of jobs added were far more than that was anticipated. The wages rose more than 3%. That's the best we've seen in the last decade or so. And also, unemployment rate was fixed at around 3.7%. The Apple did end with a cut of around 5%. It also pulled down the other few FANG stocks as well. The U.S. bond yields, that did spike up to around 3.2%. That's the 10-year yield. The 2-year yield, in fact, hit the highest levels we've seen in close to a decade. The dollar index, though, that's still held at around 96.5 odd. In terms of the European markets, more green than red is what we saw. A stress test for the European banks. That's something that was awaited. But the factory output out there did slow down a tad bit as well. Asian markets today, they have opened up with sharp cuts. A whole host of factors playing out. One is there a slowdown in terms of global growth? We have the Chinese premier that's speaking. And also later this week, we have Trump that will be going to midterm elections. Finally, the SGX Nifty is indicating a cut of around 40 to around 50 points. The good point, though, is that Brent crude prices continue to hold below $73 per barrel. Back to you.
Okay, Nigel, thanks a lot for that.